We've now been joined by Dr. Jörg Kukies, State Secretary for Financial Market Policy and European Policy at Germany's Federal Finance Ministry. Dr. Kukies, thank you so much for joining us at this time. I'm particularly pleased you have done so because I think you bring a very, very interesting insight on the world we find ourselves in today, thanks to your current role as Germany's Deputy Finance Minister and the job you had before you joined the German government, that of co-head of Germany and Austria for Goldman Sachs. You had in fact been at Goldman for 17 years before joining the government in 2018 under Finance Minister Olaf Scholz. So let's begin, Dr. Kukies, if I may, and ask you, what do you think of the behaviour of financial markets since the crisis? Do they seem rational, or are they still in denial about the scale of losses that will hit the corporate and financial sectors?
No, I mean, I think markets have been well behaved. Obviously, the severeness of the economic impact led to sell-offs in a lot of asset classes, but I would say in an orderly fashion. And I certainly, in my current position, wouldn't want to make any predictions whether or not the market is now fairly priced or not. I always get a lot of emails on that, and there is a broad range of views on this topic.
Okay, thank you. So following the 500 billion euro Franco-German plan for European recovery financing, and then the European Commission has now put forward a 750 billion euro plan, Next Generation EU, comprising 500 billion of grants and 250 billion euros of loans. Do you support this, and does it stand any chance of actually happening, considering that some countries seem determined to block it?
Yes, I think we will have a very constructive negotiation, and I think the plan has been welcomed by many, and even those who have criticized the plan or who have voiced different views than the German-French proposal have shown openness to negotiating. So I think given the urgency of the situation, I'm convinced that there will be a negotiating solution in a fairly reasonable time span.
And will you be sticking to the Franco-German plan, or will you be endorsing the larger plan?
I think it'll be a compromise, as always. So obviously, we've set our negotiating position very clear, but we all know that that there will have to be a compromise. So nobody will leave the negotiations with the same result than they wanted to have when they went in.
Okay, and does this mean an acceleration of what many have argued for in the post-crisis years, i.e. debt utilization, something that perhaps is not always very popular in your own country?
Well, I think the idea that is being followed here initially by the Franco-German proposal, which was widely embraced by the Commission, is going outside of the common, very contentious discussion around debt mutualization. So if the EU Commission has its own debt capacity and it can raise its own funds through debt, through an own funds decision which is foreseen in the treaty, then I think we have a different debate than we had around joint and several guarantees or not, or Eurobonds or Corona bonds. I think if the European Commission on its own, with no member state explicit guarantees, raises debt in markets, then this is a different form of fiscal capacity, which I think is only positive. So I'm hoping that this discussion can stay outside of the common debate around debt mutualization and Eurobonds, et cetera, which have not led to very productive results.
Well, I have to ask you then, what do you think about Eurobonds or Corona bonds? Do you like them yourself?
Well, I think we have different views on them, obviously, and whether joint and several guarantee offers the right incentives or not. Certainly Germany is very skeptical on that. But I think the key insight that everyone had is that even if we were to agree on joint and several Eurobonds today, we'd need treaty change, we'd need referenda in many member states, we'd probably be ready in 3 years or 2 or whenever, but definitely not in time to fix all of the problems that are urgently required. And I think the current situation, if we achieve the an agreement on basis of the proposal by France and Germany and the Commission, then the European Commission can raise debt through the own funds decision in a very transparent, very clear, very legally safe way, which is much better than the contentious debate around Eurobonds. And offers a very good pathway, right? I mean, if the US issues US treasuries, they don't go to California, Nevada, and Arizona and ask them for a state guarantee. They just issue it at the level of the central state, right? Which is a much cleaner way of doing things.
Indeed. Europe's common currency could well be heading for its moment of truth, with the German Constitutional Court requiring the ECB to justify its huge public sector bond buying program in early August, or continue the scheme without the Bundesbank, which is due to be buying a quarter of the bond purchases. What do you think of the Constitutional Court's decision?
Well, we obviously respect the Constitutional Court's decision, and we're working very hard. We have some tasks to do from the ruling, and we are working very hard with the European institutions, with the Bundesbank, with the German Parliament on fulfilling those requirements, and we're optimistic that we will be able to meet them within the 3-month deadline that the Constitutional Court ruling contains.
Okay. Should Germany return to the debt brake after the crisis, even if interest rates remain very low? Many economists have long thought it should invest more.
Well, if you allow the statement, had we listened to all the economists that asked us to spend more during the good times, we wouldn't have the fiscal capacity today that allows us to spend everything that we can spend. So the answer to your question is clearly yes. Germany will return to the debt brake if and when that is in line again with the constitutionally foreseen requirements, i.e., if the current special situation is no longer in place, then we will return as is constitutionally foreseen to the debt brake again.
I see. Okay. And once this crisis passes and we see a recovery in Germany's economy, will you push again for consolidation in the German banking industry?
Well, I think that's a decision that the banking industry itself has to take. We don't push for mergers, we don't push for consolidation. We push for sound capital ratios, we push for sound business models, but we certainly wouldn't put pressure on institutions to make business decisions one way or the other. That really is in the realm of the institutions to decide themselves. But we can give a framework that makes business models work. But we're doing what we can to promote the financial markets in Germany. We in particular have a European solution. We propose very far-reaching plans for a European banking union, and for us, that's the correct way for policymakers to prioritize.
You said that there is no pressure from the finance ministry to force through a merger of Deutsche and Commerzbank, but in the post-COVID world, surely there will be urgency to strengthen Germany's banking sector, or even the European banking sector. Can you imagine sanctioning a takeover by a big bank outside of Germany, for example?
Well, that's first and foremost the question of deciding on the legitimacy of a merger, if it were to happen, is more a supervisory role, which, if it's a merger of large institutions in Europe, would be the European Central Bank and the single supervisory mechanism. So it wouldn't be in our realm to make decisions on whether mergers are doable within the capital framework of the institutions concerned.
Okay, and so before joining the German Finance Ministry, you ran Goldman Sachs in Germany and Austria, an American bank in Europe. What does this crisis do to the European banking sector that is already struggling to compete with US banks in terms of profitability?
Well, at the moment, I think what we're seeing is that the banks are really reaching out massively and doing what they can, working with us to avoid the liquidity crunch that is probably the most threatening economic phenomenon that we have in the short term. And what we're seeing through our programs with KfW, we've now seen extension of more than 50,000 loans in volume of 40 billion plus to the German corporate sector, all of which has gone through a collaboration of the private public banking sector with KfW and the federal government. So in that sense, we at the moment see great activity by the banks helping to avert the crisis. But of course, every quarterly earnings report that we see, both from German banks, from European banks, from global banks, show the same phenomena, i.e. the risk of credit losses going up, the RWA consumption going up by liquidity lines being drawn, by the effects of some of the pro-cyclical effects of some of the supervisory and accounting regimes that we have. We've reacted to some of the pro-cyclicality, but you can't avoid it altogether. So obviously, yes, the answer that capital ratios are not improving in a situation like this, I think, is obvious. But I would say it's very controlled, and overall, whatever institutions we are debating this topic, it really is paying off that the financial industry has entered into this crisis in a very resilient form with strengthened capital bases.
Just sticking with that question though, so before the crisis, were you concerned at all that comparing the two sectors, the US and the European sector, that the European sector was just much less profitable? Was that a concern?
Yeah, I mean, that's why we made our proposal to strengthen the banking union and to get rid of the fragmentation and the segmentation and the restrictions to the free mobility of capital and liquidity within the European banking sector. I think that's the core analysis, and that was completely independent of the current situation. Of course, the current situation aggravates the problem, but the problem has been in existence for a long, long time. And the fact that we have a very fragmented banking sector in the European Union is a big, big detriment to its strength. The Treaty of Lisbon foresees internal markets with free flow of capital and liquidity in all goods and services sectors. We're doing a good job in goods. We're not doing a good job in financial services in fulfilling the spirit of that treaty.
Okay, people are talking about making the recovery green. Is there a realistic chance of that?
Oh yeah, I mean, just today we will decide in Germany on the next fiscal package. And one of the T's next to timely, temporary, and targeted is the fourth T, namely transformational. And we are paying a lot of attention that the future investments that we have, whether that is in the way we incentivize mobility, whether it's in the way we incentivize public investment, whether it is how we adopt the Green Deal in Germany, will contain a huge amount of CO2 carbon footprint reducing measures. And our fiscal package will be all about that, to how we strengthen aspects and elements of the carbon transition going forward.
You've bailed out Lufthansa with a €9 billion rescue package, and the largest such bailout in Germany since the crisis. But there are no environmental conditions attached. Is this a missed opportunity then?
It would be a missed opportunity if your statement were true.
No.
In fact, Lufthansa is committing to sustainability and reducing its carbon footprint by fleet renewal and promotion of carbon neutral fuels. So in that sense, I have to differ with the basis of your question. We do have very clear carbon reducing targets in the framework.
Okay, so this is a question, I suppose, linked to bailouts, but also the general public support that has been given to markets over the last 2 months. Do you think we will ever wean markets off public support?
Yes, the answer is very clearly yes. all of the measures we're doing, and the one regarding the stabilization package for Lufthansa is a very good case in point of that, includes already incentives for the exit. So in the contract that we have with Lufthansa on the measures, we commit to exiting as soon as possible. As soon as the debt instruments and the silent participation instruments are repaid. In fact, Lufthansa can insist on the federal government exiting from its investment in the common shares of Lufthansa. So in that sense, we're all about preparing things for a quick an exit as possible. And in the governance of the package that we're going into, we also limit our ability to intervene in day-to-day decisions to zero. And can only exercise our shareholder rights in very substantial matters such as dilution, mergers, or other very large, significant corporate activities, but we completely forego day-to-day attempts to co-manage the company.
And the wider part of that question was about general public sort of interventions in markets, whether that's quantitative easing or there's liquidity facilities for the banking system. These have been in place for a long, long time now. They've been brought back as even larger programs since March. So my question there is, can markets ever survive and prosper without these programs and support packages in place?
Yeah, so I wouldn't want to comment on the monetary policy side because you named some clear central bank topics, so I wouldn't want to comment on the necessity or how important and how long-lived they are. That's a clear monetary policy decision. On the fiscal side, I do think everything we're doing is very, very temporary. I mean, all of the KfW loan guarantee programs that we have an end date. They all have a sunset clause. The Economic Stabilization Fund, which is our 600 billion facility to stabilize companies, has a very clear sunset date, i.e. These funds will expire at the end of 21. So in that sense, we have a very clear ambition on the one side to only use these investment facilities for the time period where we expect impact from the current crisis to still be alive. And the investments that we're doing have clear expiry dates as well. So we're doing what we can to, yes, we're going in forcefully, but we also want to end the measures as soon as we can and as economically sensible.
Okay, so does this crisis accelerate the decline of London as Europe's leading financial centre, or do we in fact need to think beyond this and whether the coronavirus crisis will instead accelerate the end of big offices and the concept of financial centres?
I would highly doubt that. First of all, I mean, for us in the whole Brexit context, it's always been very important to maintain the connectivity between the German real economy, the German financial industry, and the City of London. I mean, it's just such a massively important concentration of capital and liquidity that is essential for the financing of our economy and the economies of Europe and the world, that I just simply can't foresee a decline of London specifically. Whether the more general point that you make around working from home and more mobile ways of working, that may or may not turn out to be true in a more in a time post-COVID, and I do expect behaviors to change there. But I highly doubt. I think the financial industry is one where proximity of ideas and idea generation is a very vital component. So I don't see that fundamentally changing.
So sitting here in London, we look on enviously at Germany with its low COVID-19 infections and death rates, its ability to unlock faster than many parts of Europe, its speed of reaction in its finance system to support the economy via banks such as KfW. But which countries do you admire in their response to COVID-19, and what could Germany have done differently?
I mean, that's certainly an area far outside of my area of expertise. So I really wouldn't want to make any speculation around that. I think Germany has reacted quite quickly. Of course, with the benefit of hindsight, you could have always reacted more quickly, but I think that's on an absolute basis impossible that everyone gets it completely right. No, but I think we're looking at a lot of the technology-based ideas that some Asian countries have followed and trying to learn from that. We're obviously thinking a lot about dependencies of our medical supply, of a lot of the medical supply that where Europe has put itself in a position of dependence. That's probably something where we will see some quite significant improvements, and things like intensive care. You can never invest enough into these things.
Mm. I mentioned KfW. KfW obviously has played an enormously important part in the German economy in post-war years, and of course has played a central role in the crisis response. Are you surprised that other countries don't have a KfW, given how well it's worked in Germany?
Well, I mean, most of our European partner states do have something more or less similar to KfW, especially in the large ones. So in that sense, I do think the idea of having promotional banks that work with the government outside of the directly profit-generating goal is something that in France, Italy, Spain all have. The US has
not the UK
sovereign banks, and I'm trying to dodge the question of the UK, but I'm not being very successful at it. But I mean, that's the UK's decision, right? So I personally can only, from my experience, both in the private sector and the public sector, say that having an institution like KfW has enormous positive elements, because as we all know, there are positive externalities to quite a lot of investment decisions that, due to the fact that private investors can't internalize them, having an institution like KfW to play that role of transmitting the positive externalities, for example, liquidity provision by the public sector in an area where each private individual is behaving rationally by withdrawing liquidity, can just be something that unlocks the economy again, right? And having an institution like KfW to basically overcome this problem that we all often have in crises, i.e. individuals acting very rationally by withdrawing liquidity, but overall that leading to adverse economic results. I mean, this sort of impact of the positive externalities of an institution like KfW, I can only recommend it. And obviously that's the decision for the UK on whether it makes sense and in which form.
It's never too late, of course, for the UK. But anyway, I mentioned you mentioned you worked at Goldman Sachs as well. So which is tougher, politics or the internal politics at an investment bank?
Oh, I think big organizations always have some elements of politics, so I wouldn't really differentiate between that. In terms of the toughness of the job, I mean, I would say the last few months were quite borderline in terms of 24/7 activity, but so far we've achieved a few results, so that's also very, very gratifying work.
So a British journalist and a German politician have managed to get through an interview without really mentioning Brexit. But sooner or later, you mentioned it very quickly once, but I can't let you get away with it. But sooner or later, the prospect of the UK leaving the EU is going to return to people's consciousness. Indeed, we have the transition extension looming in June here in the UK. So has this pandemic changed how Brexit will happen in your view? And is a hard Brexit inevitable now?
Well, I mean, first of all, obviously the entire negotiation is in very good hands in terms of the European Union with Monsieur Barnier and his team. So I wouldn't want to comment on the likelihood of a hard Brexit, but he has voiced some disappointment about the lack of progress in the negotiations. So obviously that's quite concerning for us. particularly because given that we're assuming the EU presidency in a few weeks' time, we have several dozen equivalence decisions that will be negotiated during the time of our presidency. So that will be, if I just think of how tedious and how difficult it will be to agree on all that, and I can only understand the necessity to make decisions quickly.
Dr. Jörg Kukies, thank you very much indeed.
Thank you.